Good morning and welcome to AF Oliver here in Bournemouth. Happy New Year. I think that's where we are. I'm really sorry for the late start. Technical gremlins right at the end. It's had us all leaping around in the studio here like you can't believe. Now we've got you, we'll try and see if we can eke that 5 minutes we lost at the start out of this presentation, but there are some very important things to go through. I would just like to talk a little bit about the whole forecast for the year element. It's classic, isn't it? I call this art versus science, and of course that's exactly what forecasting is. There was a very eminent physicist, Niels Bohr, who said famously, prediction is difficult, especially when it's about the future. And that's where we are, isn't it? I can roll out as many facts as you'd like me to unearth, but in the end, it's a combination of that science and that art. It's that experience and that data combined that actually allows us to make these predictions. And for this year, it's so important because the way I characterize this market right now is it's sitting on a knife edge. That's where we are. We sit on a knife edge and it could move either way. But I've got some really interesting things to set in front of you today. So let me just kick off with looking back on last year very, very briefly. And you'll have to excuse the little pun in the rhyme there. How did I do in 22? Well, you've got to do it, haven't you? You'll recall back at this time last year, January last year, I said that we would end the year with the nationwide index in 6% growth for 2022. Well, guess what? It actually ended up at 2.8% in growth. I still maintain that if Liz Truss and Kwasi Kwarteng hadn't decided to hold the ship below the waterline, I would have been bang on the money with my 6%. I'm blaming them for the 3.2% difference there. But I think against my contemporaries, that wasn't a bad result. On volumes, back at the start of the year, I was never convinced by the doomsayers on volumes that predicted a huge drop out of 2021 into 2022, and I predicted 1.3 million transactions. Well, I'm sure you're aware that this week we saw the HMRC numbers come out, and we actually ended the year, when those numbers get verified, we ended the year at 1.258 million. So, well, there's 42,000 out across 1.3 million. I don't think that's too bad. And I feel reasonably confident that we'll be in around the right sort of level for next year. But more of that later. While we were on this whole rhyming thing, I thought, how do they see 23? I thought that was worth having a go at as well. Just before I tell you the way I see 23, how about the rest? The Ernst & Young, the EY item club there is in minus 10% for next year. We've got the Halifax, they have weighed in with minus 8% for next year. And then we've got the Nationwide. The Nationwide have come in with minus 5% for next year. And Zoopla as well. They've come in for minus 5%. I'll come to what I think next year is going to do very shortly, but I thought it was worth just seeing what those other key indicators looked like. In the meantime, here we are with the stuff that's going on as we move out of 22 and into 23, and the media have been going crazy, haven't they? And this is just the most extraordinary combination of headlines where we've had the biggest UK house price fall recorded since the financial crisis. Lovely, okay. And then we've had cost of living, rents and house prices continue to rise. Okay, these two stories, the BBC there, these two stories were in the space of about 48 hours of each other. Here we go, here's another one out of the Independent. 10 areas in the UK where house prices are predicted to fall the most. And on it went. These two I love. This was out of the FT. Bank of England expected to keep up interest rate rises, and that's absolutely true. And in the FT Advisor, just 2 days later, Here we go. Sub 4% fixed mortgage rates could be here by March. I understand we're now in a bidding war with the institutions looking to try and lower those rates and grab mortgage business. Just absolutely perfect. Here's The Guardian. Well, you've always got to lean into The Guardian at times like this. UK lenders fear spike in mortgage defaults as the cost of living hits home. Mortgage defaults now are way lower than anybody predicted and look to stay that way. The changes in 2013 and 2014 to bring that stability into the market after the crash in 08-09 has really had an effect. These mortgages are stress tested up to 7%, and I do not believe for one moment we will ever get there. So I still don't believe we're going to see a crash. And why? I don't want to sound like a Pollyanna. The last thing in the world I want to do is just trot out good news. There are lots of bad things going on out there and lots of worrying factors. Like I say, this market sits on a knife edge and it would be easy to be proven wrong. But just have a look at this. The Rightmove index. Who would have thought the Rightmove index would have actually upticked in January, went up 0.9 of a percentage point. Asking price index, that is, of course. GDP, every commentator that you could possibly talk to said, well, GDP is going to come down in November and in December. We will end up moving into recession by the end of the year. Well, of course, that didn't actually happen. It actually went up by 0.5% in October and 0.1% in November. It is likely it will be a negative figure in December, but the newspapers must be furious because they can't now say, guess what, we're in recession. You know, that you can imagine the editors queuing up ready to write the story, and they can't actually do that. Inflation actually came down. The rate of inflation came down in December. Again, completely against all the odds. And don't forget, we now, as we move into January on the inflation front, we're starting to catch up with all those crazy rises. When we get through January, February, the crazy rises that coincided with the Russian invasion of Ukraine last February. Almost a year ago now. Extraordinary, isn't it? Now, it's almost certain that next week we will see another 0.5% go on base rates to take them to 4%. February 2nd, the MPC meet, and I would be very surprised if we don't see a rise on that day. But mortgage rates are still falling. So that's feeding through. And lastly, the employment market is still very, very strong. Not quite as hot as it was, but it is still hot. So those factors, and like I say, I don't want to be a Pollyanna. There are lots of other factors out there, negative factors, that we'll look at in a moment or two, that do affect the way that the market moves, but those factors are out there and that does affect things. And for me, that means we come down the right side of the knife edge rather than the wrong side of the knife edge. Let's have a look then. So this was last month's market factor matrix. Okay, my apologies for this little graphic at the top of my screen. You remember I was talking about technical problems earlier on? Well, there you go. That's just some of the stuff we've been battling with this morning. So let's just first of all have a look at last month's market factor matrix. And you can actually see here that the low affordability, low consumer confidence, rising mortgage rates, these were all of the key negative factors that were affecting sentiment and driving sentiment backwards. Low supply, high demand was starting to move backwards. The stamp duty changes obviously were in there as a positive. And then the developer created enablers, things like discounting at the front line, financial products with the IFAs. You know, we all obviously are acutely aware of Help to Buy going in 2022, and lots of developers have got out there and worked really hard and really creatively to replace that product with one of their own, and of course part exchange. More about part exchange later. But actually, when I look at how that chart looks on today's matrix, it actually looks very different. Just note here, okay, the low supply, high demand element, the positive element in there, is moving back slightly. You can see it moving back slightly. The big standout here now is the developer-led enablers. This is the opportunity the developers have to actually really leverage their power, and they are going to have to do that because of the shrink in the new homes premium that I'll talk about in a moment or two. Coming down into the negative areas, so these are the things when I'm trying to calculate just how this market is going to move, these are the things that actually have the biggest effect and the most dramatic effect. These rising mortgage rates, you can see how that has shifted back, because I think people are now starting to be aware that while base rates are rising and there are more rate rises to come, there is undoubtedly a calmer view in the MPC. You already had 2 votes against the raise last month. So there is already a calmer view, and they can see what's going on in the mortgage market because they're not stupid. Consumers are not stupid. Here it is. Mortgage availability, which is that atom bomb of an element in consumer confidence that affected us so dramatically back in September, October. That I've moved right back because there are now so many more mortgage products available on the market. Low affordability is also moving back here. Consumer confidence is also moving back here. We'll come to that in a moment. And running costs, because these costs are now starting to be factored in our target market. So you can see this is where the matrix is looking, and this is why I'm thinking the right side of this knife edge. Let's pick those elements in that matrix apart and look at them in a bit more detail, because these are the fundamental elements that are affecting the market. Let's kick off with the big one, interest rates. Now, we all know that if you kick up mortgage rates, you will drive down activity in the market. You'll destroy confidence and you'll drive down activity in the market. This is a crucial part of the way that the market operates. So here are the numbers from the end of December. And you can see, here's where the mortgage rates took a huge uptick. Inflation was already coming into the system as we came through last spring. And then, of course, we had the huge rise after the mini budget September. And we came right up to this peak here. And we have just now started to tail off. And I always think that you can always tell how interest rates are going to go, because the clever money, these guys up in the city, they know, don't they, what's going on. And when the 5-year money is cheaper than the 2-year money, I think we all know which direction interest rates are going to move in. I don't think there's any doubt about that. If you look at where we ended the month, so this was where we ended December, and in here you can see that on the very highest loans to value, the 95% loans to value, 6 and a bit percent up here. But then when you come right down here to 60% loan to value on a 2-year fix, 5.3%. And if you look, all of these here are 75% loan to value. And it's interesting to see that a 2-year fix on a 75% is just under 5.5% as at the end of December. And then the 10-year is right down here under 5%. So that's the way the markets are seeing it. And don't forget, I talk about 0.5% going on base rates, Bank of England base rates on February the 2nd. 67%, over 2/3 of the markets have actually priced that increase in already. They're already seeing that. And here's another thing that, these were numbers from the end of December. Have a look at this. This little chart I nicked off of Money Facts, and this is what they are offering. Okay, how about this one? Now, this was my favorite here. A discounted variable mortgage here you can get right now at 2.94%. Okay, that's discounted. So you get a period of time where it's 2.94 and then it reverts back up to its higher rate. But these are we're talking about numbers here on offer right now to the public at under 3%. There isn't any doubt about where rates are going. If you look over here, this is for home movers, so second time or third time buyers, and you can see here 2-year fixed, and this isn't a discounted rate, at 4.5%, under 4.5%. So these are rates that are out there right now. So the interest rate thing I won't apologise for spending a lot of time on interest rates because it's such an important part of market sentiment. But you can see where they're headed, despite the fact that we are going to get almost certainly 50 basis points go on February the 2nd. So that's interest rates. And I think the public are getting that their general direction is down from that crazy high that we got after the mini budget. And then what about general consumer sentiment? Because that's another really important box on that market matrix, isn't it? Well, here it is. Here's that classic GfK, brilliant GfK consumer confidence barometer. This one published just this week. And you can see where we are. We'd been coming down here from, here's February here. This is pretty much where consumer confidence took a real dive after the war in Ukraine started. And don't forget, this red line here, this shows anything below that red line is the majority of the 2,000 people that they interview every month say things are getting worse, as against above this line, things are getting better. So you can see that the majority view is very much in negative. And it from February, it really picked up pace. This bottom line here, this blue one here, is how they feel the UK economy is going to perform over the next 12 months. And this hit 50-year record lows. This confidence barometer has actually been in existence for 50 years now. National opinion polls used to do it before it was acquired by GfK. And you can see this was a record down here, an unbelievable low number, the sort of number I've never seen before. The red line here is the general confidence index, and that also, this is just after the mini budget. Everybody wanted to put their head in a bucket of cold water, didn't they? It was just terrible. They all thought the world was going to come to an end, and this was that base point. But since then, the government has stabilised. We've got new people there. It might not be what everybody wants. There's lots of, there are lots of additional costs and pain out there, but at least it's stable. And confidence has started to return. And okay, these are still in deep negatives. And again, I'm sounding like the eternal optimist, and I don't mean to do that. I'm just giving you my take on why I think the market is going to move, where it's going to go. And heavens, look at the shirt I'm wearing. That gives you some sort of sense or an idea. But you can see how confidence has started to improve. It's still at a low level, but it started to improve. It took a slight downtick from December into January, but guess what? That's what happens after Christmas. It's gloomy January, isn't it? And everybody feels a little bit downbeat. That's how we all feel. As the skies are grey and it never stops raining, and that tends to have an effect on those sorts of surveys. For me, I look at this and I see that it's sat down there, it's still at close to record lows, but my general sense is that people are taking the pain, they understand it, but there is a confidence that it's not going to get worse than where we are right now. Another one of those boxes on that matrix was, of course, inflation. And I think we are past the peak rate of inflation. Certainly, the government believed that. I mean, Rishi himself came out and said, we will halve the rate of inflation before the end of the year, didn't he? And he's come out and actually said that. So now they've got to make it happen. That's a little bit worrying when it comes back to interest rates. But nevertheless, I think now as we start to get all of those huge hikes factored in, so, the massive fuel price hike that happened in February, March, that all of that will start coming into the numbers now as we come through these months. And I think that we are going to see this rate of inflation drop. And that then has a knock-on effect on so many other things that involve or are the building blocks of consumer sentiment when it comes to buying houses. I love the Zoopla demand chart. I'm a great believer in it. One of the things, though, that really hurts me is when Zoopla published the numbers for levels of demand. And so this was their number for November into December, and they showed demand dropping by 49%. Well, the newspapers had a field day with that, didn't they? The mainstream media, oh my God, demand has dropped by almost half. Have a look at this great big mauve block next to it, because that is the level of fall in demand November into December, for the 3 years prior to COVID, oh, look at that, minus 46%. Yes, because it's a seasonal shift. And if only we could actually get better and more balanced reporting, we'd all be in a much better place. But so there is, okay, that gives me slight cause for concern, but certainly no panic, that's for sure. So that's supply and demand. Let's have a look at some of the most recent data. And I'm aware we kicked off with a late start, so I'm going to race through these because most of them you already know. Who'd have thought that the Rightmove house price index was going to uptick by 0.9%? Unbelievable. So I painted this asking price trend when we actually looked at it back in December, wasn't it? I know November was our last MarketCast, and I certainly wasn't expecting this little uptick here. But there it is. I still think our trend is coming here. I'm pretty sure of that, but just it goes to show how the market can actually surprise you. One of the things, of course, with the way that the market and the slowdown in the rate of asking prices rising over the past few months means that affordability improves. So we can see here affordability improving for first-time buyers, and also the cost of buying as against the cost of renting is starting to improve as well. These numbers are all on the Rightmove website. I'm not going to dwell on them on here. Lots of red arrows on that screen because what I try and do that, although the Rightmove UK map shows some in positive and some in negative, I actually compare the 3 months to 3 months on this chart, and the trend on all of these is a reduction in the rate of inflation right across the UK. Nationwide comes out tomorrow, I think it is, or next week, sorry. And you can see though, if we look back at their December numbers, it was a big fall and dropped down to 2.8%, just when I thought I was going to hit it bang on. This is quite interesting. These are the regions through the whole of the UK. This is Q3 versus Q4. So Q3 is the green, Q4, and you can see that fall in values according to the Nationwide. And don't forget, they base their index on mortgage approvals, is pretty much uniform right the way across the whole of the UK. And what that also means, another one of the little benefits there, is that the price to earnings ratio falls slightly too. And this was at a record high. So to see this fall has got to be a good thing. And it's another thing I think that will contribute to a levelling out in the way that the market's moving. The newspapers loved this. The Halifax weighed in with I think it was their record ever fall. They're 40 years old, of course, the Halifax Index now, 1983. I remember when it came out. I think I was 2 years old. I can't, but I remember when the Halifax was actually launched, and here it is, 40 years old, and still telling us that the world's about to come to an end. But it was still in positive inflation, but only just according to the Halifax at the end of the year. 1.5% down on the month, 2% positive inflation on the year. Zoopla, they're running at 7.2% with their blend on sold prices, mortgage approvals, and asking prices, which I think is a great index. And you can see that it's as steady as we go. Their cities index, which is always a month behind, this is the November index. This demonstrates the huge variance in between the regional markets. Nottingham sat up there at 10% inflation on the year, excuse me, and Aberdeen down there in negative growth. You're talking about 10% difference between top and bottom. Absolutely extraordinary. Mortgage approvals. This was another number that the press picked out and said how worried they were. Have a little think about this. So here are now normally that mortgage approval data there with that big drop off here. This was lockdown 2020 and COVID. Then we started evening out and with an average above pre-COVID numbers. And then suddenly we take this great big drop down. These are the October numbers. Well, guess what? Anybody remember the mini budget? Did I mention that earlier? Because immediately after the mini budget, if you remember, all the building societies and banks took their bloody products off the market. You couldn't get a mortgage. So it's little wonder that mortgage approvals dropped. And you can see that for house purchases, they dropped down to 46,000. That's probably 20,000 below where they should have been. But that's purely because there wasn't the mortgage availability. And those of you who've watched a few of these MarketCasts, you'll know that mortgage availability is the real key. If you take the mortgages away, you stop people buying houses. It's as simple as that. But this number is far less dramatic than it might at first appear. Again, I'm sounding a bit too much like an optimist, but that number didn't shock me, and I'm absolutely convinced that when we see the December numbers, that they will have returned to normality. And here we go. So these were the values. This was the 108,000 non-seasonally adjusted volume in December that brought us up to just under that 1.3 million for the year. I don't want to dwell too much on the RICS because we'll all be flinging ourselves off of a high building. Here's the 0 point. This is the surveyors and agents thinking things are going to get worse below that line, thinking it's going to get better is above that line. And you can see these are the newly agreed sales as we move November into December. Well, to be fair, there's a lot of seasonality in there too. These are new instructions, and with the exception, I think, of North there, pretty much every region, certainly every region in England, in negative. Look at this here. This is North again. This is again we've got obviously a very optimistic agent up there somewhere that's driving the thinking for North. But you can see these are new buyer inquiries. But this is December. This is December. But you can see where they are in negative. And these are how prices have moved over the past 3 months, with the vast majority of agents right the way across the UK saying they have been in negative too. And this is where they see prices going. Here's the neutral 0 line, and you can see both on the 12-month measure, that's the aqua coloured line, and the 3-month measure, the mauve line. The vast majority of agents believe they'll be in negative, and you don't need me to explain that chart, do you? Stock per agent has fallen, and that actually did surprise me slightly. And you can see there for the December numbers, it showed another small drop. That was a surprise, and that also obviously plays into the supply and demand question too. Okay, enough of that. There's enough of that data there. Please, all of that data is freely available, so you'll have plenty of time to take a look at that in your leisure. I think really what today is all about, and the crucial factor for today is determining what's going to happen as we go through 2023. Some really important decisions are going to be made on the back of that. I set out my forecast. It looks like this. Here we are. This is based on the nationwide numbers. So you need a measure somewhere to actually anchor a point so that we can see where we're moving. Famously, there are quite a few people out there that make a prediction about the market and then don't say which index it should be measured against. So this is against the nationwide. It would be the ONS, Land Registry, but the data is so out of date, you don't get it until 3 months after the event. So this is how we come into to the start of the year. It was 2.8%, you'll remember, at the end of December. And I'm seeing that drop down to just under 2% for January. And then I think we drop into negative for February as we go then through the rest of the year. But nothing like the speed of decline that has been predicted by others. And you have seen some crazy predictions out there. And you can see this is me seeing the year end in December at 4% below where we currently are. But the important thing, that's the rate of inflation for an average home. This red line here paints the average price if these predictions on the rate of inflation are correct. So if, for example, we see in March a rate of inflation at just under minus 1%, house prices will actually be going up at that point. And I got so excited there. And they're actually going up. And you may call this crazy, but you are just going to have to go with me on my intuition, my experience, that I believe we are going to see an uptick in March. I'm absolutely convinced of it. If all of those factors in the matrix are correct, then I think there is an opportunity there that we'll see a slight uplift. You will see a fall in the rate of inflation, but the actual physical prices, I think, will go up through spring. Not by much, but they will go up. And I think you'll see the average nationwide price sitting somewhere in the mid 260s. And then it will start to fall as we come through into the summer and then head back into the winter season again and into December. And I think it will end the year at about 252, about 4% lower than where we are now. So that is how I see the year panning out. This is the big one for any developers, builders watching this. The difference in between the price of a new home, the average price of the new home, and the average price of a second-hand home. Now, the raw numbers are unimportant because there are so many other factors that affect it. You know, the size of the houses that are being built, and the age of the stock and so on. But the relationship between those two lines is important. It's good data. It's good data. It's land registry data. It's been kept since 2005. So we've got a good long series here. And you can see how the lines move apart and converge. Well, they converge when there's been a difficult market. 08, 09 was its lowest point ever. It came down to 13% rather. It currently sits on the latest numbers that the Land Registry published, which was September, end of September numbers, at 38%. I am absolutely certain that that number will reduce. And that means that the developers are going to take the biggest hit on fall in asking prices. So that's something that we really need to be aware of, and we need to climb all over. I'll be keeping a very, very careful eye on these numbers. Unfortunately, they're Land Registry numbers, so they're always slightly old. So September is the latest that I've got, but I'll be updating those on a regular basis. But we really need to be aware of those because competition from the second-hand market, as supply has improved, obviously increases. So in summary then, and I really am sorry we're running late this morning. I hope we've kept as many of you as possible. Our best ever audience today. So thank you so much for that. Hope you're enjoying the shirt, by the way, my Secret Santa shirt. In summary, I am still absolutely convinced, and I keep saying this, reputation is now riding on it. There is not going to be a crash in this market unless something absolutely cataclysmic happens, and hopefully that won't be the case. I know it's crazy, but I believe that there will be an uptick in the spring, and I think that's a big opportunity. Certainly for you guys out there looking at marketing campaigns and the timing of those, I think there is a genuine opportunity in spring to take advantage of that market. I think it's going to happen. The values of a new property are going to fall faster than those of second-hand. I say the values, the asking prices, we need to be aware of that. That's really important. I think that we're going to end next year at about -4%. I think in terms of volumes, we're going to end up between 1 million and 1.1 million. I absolutely believe that's the case. And I think that the new home share of that will be around 12.5%. So how does that pan out then in Q1 strategy? I hope everyone out there now has built themselves an offer to replace Help to Buy. Just think about Help to Buy and about how huge it was. You know, best part of 400,000 people have bought on Help to Buy in the 10 years that we had it from 2013 up to the end of last year. You know, we're talking about £100 billion worth of property. It's absolutely massive. So you need to be out there. You know, I look at the sort of stuff that some people like Fairview have done with their magnificent Save to Buy scheme. Persimmon have also been really busy on building there. There are a few guys out there that are doing that and really working at it hard with their IFAs. That's so important. That's a really important part of what we're doing. We are in absolute fertile ground for part exchange. This is like, you know, I used to say we have a double-barreled shotgun in new homes. We've got Help to Buy and we've got part exchange. Okay, one barrel's gone, but we have still got the other one, and it's a howitzer. And we are right in the very best. We're in the sweet spot for part exchange. Think of it, I call it my rubber band theory. Think of a nail in a piece of wood. When the market's really bad, you tug that rubber band around the nail that way. When the market's really bad, your offer for somebody's PX property is so low, they hate you. They actually want to come round and kidnap your dog. They're so angry because you made them an offer for your PX property, and it's just terrible. Personal insult. When the market's really good, the rubber band stretches the other way, doesn't it? Why do I need to part exchange with you? I can sell my house myself and then do what I want to and maybe not buy your product. And sitting there in the middle is this transitional period. PX is going to be very, very big this spring. To turn it into a fashion statement, I think we'll all be wearing a bit of PX this spring. The sales teams need to be aware of that too, don't they? And it's extraordinary. If you get someone that really gets how PX works, they are so much better at selling it. So that's crucial. Local price variations, you don't need me to tell you that, but I feel if I missed it off there, we've got to be aware of that. Take advantage of prices where the market allows. There will still be markets in the UK in 2023 that will be in positive growth at the end of the year. I guarantee that, absolutely guarantee it. So we need to take advantage of those markets. Strong trading partnerships during these difficult times, especially as we move into the summer. And I'm not just talking about with your estate agents and with your IFAs, that's obviously crucial, but people like the registered providers, who are there and who are looking to be as active as possible. The shared ownership market is one that really, I think, has got its day coming over the next 12, 24 months with the situation that we find ourselves in and the disappearance of Help to Buy and so on. And they can be great business partners over the next couple of years. And finally, start a communication revolution in your business. You just think about it. Your frontline sales teams, everyone that's coming into your office every day and is building and working under your brand, are reading those crazy news stories that I put on right at the start of this presentation. Make sure they know how the market is really moving. So give them an understanding of how the market's moving, and it will change the way. I'm not saying that we turn them into market gurus talking to people that are actually coming in to visit, but it will change the way they view their interaction and their negotiation with prospective buyers. That's a really important thing to do. Put that on your to-do list for sure. Okay, sorry about the overrun, sorry about the late start, sorry about the little technical glitch, sorry about all those things. It's the first one of the new year. It's the first one of the new year. It's going to get better. Great to have you with us this morning. Please put February in your diary. A huge thanks to the team here as ever, Hannah, Joan and James, who've battled with the issues that we've had this morning, done a great job. And we will see you again at the end of February.